There's a stock on NASDAQ that had its share suspended for more than 2 years. Not halted for an hour during a news event, suspended, locked. The company behind it was effectively sanctioned into silence, written off by most of the market as collateral damage from a geopolitical crisis that had nothing to do with its technology and everything to do with where it was born. Most investors moved on. The ticker sat dormant. And then the shares came back. And this is what the numbers look like now. Revenue up 479% year over year. Gross margin at 69%. Positive adjusted EBITDA in the fourth quarter. A cash position of $3.68 billion. And a Wall Street consensus price target more than 70% above where the stock is trading today. The company is called Nebius Group, ticker NBIS. If you have never heard of it, that is part of the story. If you have, and you still are not sure what to make of it, that is also part of the story. Because Nebius sits at the intersection of 3 things that tend to create either massive opportunity or massive confusion: AI infrastructure, geopolitical baggage, and capital-intensive growth at a pace the market doesn't quite know how to price. This is worth understanding clearly. So let's do that. Strip away the history for a moment and ask the simple question: what does this company actually do? Nebius builds and operates AI infrastructure. Specifically, it owns large clusters of GPUs, graphics processing units, the hardware that powers the training and deployment of AI models, and rents that compute capacity to AI companies who need it. It runs the cloud platforms on top of that hardware. It offers the software tools that make the hardware useful at scale. The business model is not complicated. You need GPU compute, you pay Nebius for it. It is not a chip company. It does not design hardware. It is not building a frontier AI model. It is in the business of selling the raw computational power that other people use to build those things. Think of it as the infrastructure layer underneath the AI economy. The part that is less glamorous than the headline models, but arguably more fundamental. There are 3 smaller business units alongside the core cloud operation. Toloka does AI data labeling. 1010 runs tech training courses. Avride is working on autonomous vehicle technology. These are real businesses with real revenue, but they are not the investment thesis. The AI cloud segment is. Everything else is context. Now, the part that requires a direct answer. Yes, Nebius is the international spin-off of Yandex, Russia's largest tech company. That lineage is real, and it matters for understanding how the company got here. But it does not describe what the company is today. Nebius sold its Russian operations in 2024. There are no Russian employees, no Russian revenue, no Russian assets remaining. The company is incorporated in the Netherlands, listed on NASDAQ, and operates in Europe, the United States, and Israel. The divestiture was complete. Investors in NBIS are not buying Russian tech exposure. They are buying GPU cloud infrastructure with a European and American operational footprint. The history is worth knowing. It is not worth dwelling on. So what do the actual numbers say? Start with revenue, because the revenue trajectory is the first thing that should make you stop and look twice. In 2023, Nebius generated $20.9 million in total revenue. In 2024, $117.5 million. In 2025, $529.8 million. That is not growth. That is a company that multiplied its top line by 25 in 2 years. The driver is not mystery. The AI build-out created demand for GPU compute that outpaced available supply across the entire market. Nebius had capacity to sell, priced it at scale, and signed major multi-year contracts, including with Meta and Microsoft, that turned the revenue line from a speculation into a contracted reality. The backlog is not hypothetical. It is sold. Gross margin reached 69% for the full year. That number is doing a lot of work, and it is worth pausing on it. A 69% gross margin on a capital-intensive infrastructure business is not typical. It signals that the pricing power is real, that the platform is not being discounted to fill capacity, and that as utilization increases, the unit economics get better, not worse. This is a business that scales with leverage. Now for the part that looks alarming. GAAP operating loss of $596 million for the year. Here is what that number contains. Nebius is in the middle of one of the most aggressive infrastructure build-outs in the public markets. It is constructing data centers, procuring GPUs, hiring engineers, and laying the foundation for a capacity base that will generate revenue for years. A significant portion of what shows up as an operating loss is the cost of that build hitting the income statement before the revenue it will generate has arrived. That does not make the loss irrelevant, but it does mean that reading the GAAP operating loss in isolation without understanding what it is funding gives you an incomplete picture. The adjusted EBITDA number tells a different story. For the full year, the adjusted EBITDA loss was $64.9 million, a 71% improvement from 2024, and in the fourth quarter specifically, adjusted EBITDA turned positive for the first time, $15 million. That is a small number in absolute terms. It is a significant number structurally. It means the core cloud business at current scale is no longer burning cash on operations. It is now generating it. The question from here is not whether the business can be profitable. The Q4 number already answered that. The question is how quickly the margin structure compounds as capacity fills. Before moving on, consider this. CoreWeave, arguably Nebius's closest private market peer in dedicated AI cloud infrastructure, was valued at roughly $23 billion when it went public. Nebius is on the public market right now with a revenue trajectory and margin profile that is worth putting directly alongside that comparison. What multiple on Nebius's 2026 projected revenue does that imply? Hold that question. The answer requires one more layer of context before it becomes useful. The 2026 CapEx guidance is $16 to $20 billion. Let that number sit for a second. The company had $3.68 billion in cash at year-end 2025. The guidance calls for spending $16 to $20 billion on new infrastructure in the coming year. The company's own math says roughly 60% of that comes from cash on hand and operating cash flow. The remaining 40%, somewhere in the range of $6 to $8 billion, needs to come from somewhere else. That somewhere is a mix of additional debt, equity raises, asset-backed financing, and potentially asset sales. Total debt is already around $4.9 billion, primarily in convertible notes. The current ratio is healthy at 3.08, and operating cash flow hit $401.9 million for the year, with $834 million in the fourth quarter alone, driven in part by large upfront customer payments that provide genuine working capital visibility. The balance sheet is liquid. This is not a company approaching distress, but the implication is clear. Nebius will return to capital markets multiple times over the next 18 to 24 months. Each return is a dilution event for existing shareholders. The question is not whether dilution will happen. It will. The question is at what price it happens, and whether the revenue growth it funds justifies the cost. The execution risk underneath this is specific. Nebius has targeted 9 new data center sites. Each one requires power contracts, physical construction, GPU procurement, and operational ramp-up, all on a timeline aggressive enough to support 2026 guidance. Any of those variables can slip. Power contracts are not negotiated quickly. Construction timelines have their own physics. GPU procurement at scale requires relationships that take time to build, even with an NVIDIA equity tie-in. None of this is reason to dismiss the investment case. It is reason to be honest about what kind of investment this is. This is not a business where the outcome is already visible and you are simply waiting for the market to catch up. This is a business where the outcome depends on a series of execution decisions being made correctly, in sequence, under significant capital pressure. That is a different risk profile than it might appear from the revenue chart alone. Now put the competitive picture in the right frame, because the instinctive reaction, small company competing with AWS, is both true and almost entirely unhelpful. Yes, Amazon Web Services, Microsoft Azure, and Google Cloud are vastly larger. Yes, they have more customers, more engineering talent, and more capital than Nebius will have for the foreseeable future. That is not the relevant comparison for where Nebius is operating today. The hyperscalers are not the immediate competitive threat. They are capacity constrained themselves. The AI labs building at the frontier, the companies that need enormous GPU clusters for model training runs, are signing deals with whoever has the compute available, because available compute is the scarce resource in this market. Nebius is not stealing customers from AWS. It is serving demand that AWS cannot fully satisfy at the pace the market requires. The more relevant competition is the cluster of dedicated AI cloud companies, CoreWeave, Crusoe, Lambda, and others building in the same space. This is a real competitive set with real overlap. What distinguishes Nebius within it? A few things worth taking seriously. The NVIDIA equity relationship matters. Strategic alignment at the hardware level is not just a press release. It affects allocation priority during periods of GPU scarcity, and GPU scarcity has defined this market cycle. The European operational footprint matters for data sovereignty, regulatory compliance, and the growing number of enterprises that cannot put sensitive workloads on U.S. infrastructure. The software layer, Token Factory, Ether, the Tavily acquisition, is the company's attempt to increase revenue per GPU over time, which is the right strategic direction if you believe hardware margins will eventually compress. And the current sold-out status, with contracted backlog extending into 2026, is not a marketing claim. It is evidence that demand exceeds supply right now at current pricing. The barriers to entry in this market are real and already in place. Procuring GPUs at scale requires capital and relationships. Power contracts take years to negotiate. Data center construction has a long lead time. Nebius is already past those barriers. A new entrant trying to compete from scratch today is not entering the same market. They are starting a race that is already several laps in. Here is the honest question, though. The hyperscalers are capacity constrained today. What happens in 2027 or 2028 when they complete their own massive build-outs and bring significant new supply online? Where does AI compute demand sit relative to supply at that point? If demand continues to compound, which the current trajectory of model complexity and enterprise adoption suggests it will, the market may be large enough to absorb new supply without pricing pressure. If demand plateaus or supply surges faster than expected, the pricing power that supports Nebius's 69% gross margin gets tested. Where you land on that question is probably the most important variable in the entire thesis. Now to the valuation, and to the one thing most analysis of this stock either overstates or understates. The stock is trading in the range of $90 to $100. Analyst consensus price target from 13 to 14 Wall Street firms is $157 to $166. The full range runs from $84 on the low end to $211 on the high end. That is not analyst disagreement. That is genuinely wide outcome variance being priced honestly by people who have done the work. Think through two scenarios, because that is the only rigorous way to approach a name with this profile. In the bull scenario, 2026 revenue hits the high end of guidance at $3.4 billion. Adjusted EBITDA margins move toward the guided 40%. The company funds its CapEx without diluting shareholders by more than 15 to 20%, and the debt service remains manageable as operating cash flow scales. On those numbers, Nebius is cheap relative to private market comps, cheap relative to the revenue multiple the market has historically awarded to hyper-growth infrastructure names, and the stock has a credible path well above current consensus targets. In the bear scenario, one of the 9 data center sites hits a significant delay. a capital raise happens at a price that implies more dilution than the market expected. Or, more broadly, AI sentiment shifts. A risk-off move in growth multiples. A reassessment of how quickly enterprise AI adoption will scale. Or a broader macro tightening. And the multiple the market is willing to pay for forward revenue compresses. In that scenario, the stock does not drift lower. It moves sharply. The beta here is elevated for a reason. This is a name that will react to sentiment as much as to fundamentals in the short term. The one number that anchors everything. 2026 guidance implies roughly a six-fold increase in revenue from 2025. If that happens, the trajectory re-rates the stock almost regardless of what valuation framework you apply. If it misses by 20 to 30%, the funding math tightens, the narrative breaks, and sentiment reverses hard. There is no soft landing in a name like this. The outcome distribution is wide, and the tails are fat. That is either a reason to be interested or a reason to walk away. Which one depends entirely on the investor. So here is the honest frame for holding this. Nebius is a company that survived a geopolitical event that would have ended most businesses, rebuilt itself around one of the defining infrastructure bets of the current technology cycle, and is executing at a pace that places it among the fastest-growing public companies in any sector. The AI build-out it is serving is real. The contracts are real. The margin structure is real. The risk is not whether the opportunity is real. It clearly is. The risk is whether this specific company, at this specific valuation, with this specific funding requirement and execution timeline, is the right vehicle for capturing it. And at what position size. If the management team builds the capacity on schedule, funds it without excessive dilution, and the AI compute market absorbs the new supply at current pricing, the return from current levels could be significant. If any of those variables slip, the position will be painful before it recovers, if it recovers on the original timeline. A multi-year horizon, a high tolerance for volatility, and a position size that reflects the execution uncertainty rather than just the upside case. That is the honest framework for holding NBIS. Everything else is just noise. This video is for educational purposes only and does not constitute financial or investment advice. The analysis is based on publicly available information as of March 2026. Do your own research. The responsibility for any investment decision is yours alone.